markets. It is Fed Day today. Futures market fully pricing in a quarter-point hike announced later today with a 15% chance of no hike at all. We'll hear from Federal Reserve Chairman Jay Powell this afternoon at 2:30 p.m. Eastern following the decision. Joining us now to weigh in is SMBC Chief Economist and America First Policy Institute Senior Fellow Joe LaVorgna is here. Joe, great to see you.
Thanks, Maria. Great to be here.
Thanks so much for being here. What do you think the Fed does?
No move.
Whoa.
NQT. Highlight the fact that if things change or evolve the way we expect, we could go back to rate hikes in May, because don't forget they've got the forecasts they can give us. The worst thing they could do is tighten rates, because the Fed helped cause the problem we have. By taking short rates over 5%, you could earn over 5% on T-bills. Money left the banking system, went to money market funds. Raising rates only further exacerbates that problem. And by the way, spreads aren't coming in, so the mortgage market's on its back, the commercial real estate market's on its back, manufacturing's in recession. All the guideposts are there.
I mean, how about just admitting the fact that you're back to easing? I mean, all of those efforts last week to help the banking sector, to me, it looked like quantitative easing. I mean, opening up this discount window.
Yeah, right, de facto easing.
So how are you going to raise rates when, in fact, you're easing on the other side?
Well, here's what I would say, Maria. The Fed went too far, too fast. I mean, in the last 11 months, they've increased interest rates 450 basis points. That's the biggest increase since 81, 82. If you look at household borrowing
and by
rates.
the way, the fastest.
And the fastest, right, the fastest and the biggest.
So it's a double whammy.
So here's the thing. If you look at the household sector, mortgage rates are at 20-plus-year highs. Credit card rates have never been higher. Auto loans, personal loans, all those rates are up. So if you look at effective household borrowing rates, they're the highest in at least 20 years. So households have seen significant tightening of financial conditions. So, and by the way, if the 10-year Treasury rallies to 350 again or 335, which was the low on the year, but the mortgage bankers aren't lending because they're worried about their deposit base and liquidity in the markets, those low rates are reflective of financial stress. It's not strength. It's not an easing of financial conditions.
What do you think?
Well, I'm just wondering on this no hike idea. Janet Yellen this week basically implicitly put a taxpayer safety net under the whole banking system.
Well, how do you support all deposits?
Yeah, I think you say 18 trillion, something in that neighborhood.
$18 trillion in deposits?
So this is a terrible decision.
Yeah,
it will lead to disasters down the road. Everything we know from history says this is going to lead to less stable banks, not stronger banks. It's going to encourage risk-taking. It's terrible policy. But in the short term, doesn't this relieve the stress and suggest you don't need to also cut rates or maintain them?
It does relieve this. It's a psychological issue. It's like Draghi back in 2012. I'll do whatever it takes. So he didn't have to do anything, but effectively that's the confidence game. It's bad, James, because it'll make the bigger banks bigger. You're going to hurt the small and medium-sized banks, which are very important regionally and locally to get credit to those local businesses, which are the generators of jobs. That's the problem. The big become bigger.
I read her comments to say the safety net is under everybody.
It is, but what will wind up happening, though, is still the bigger banks will eventually attract the deposits. I mean, we've gotten. If you look at the
Bank of America got like $15 billion.
All these banks have become much bigger.
Going to like J.P. Morgan.
Yeah, right. So, but the reason the Fed has to cut, is because if I look at manufacturing, it's in recession. I see housing is in recession. Construction employment has been robust, but we saw the job openings rate in February collapse at the biggest pace ever. Just construction job loss alone could push the unemployment rate up 0.5 point. So to me, I see a lot of fissures in the foundation of the economy. The leading indicators are telling us that it's been down something like 11 months in a row. It's down 6% year on year. The yield curve is massively inverted. Banks are tightening lending standards. I mean, this is a slow motion recession, but when it hits, it could be very deep.
What's going on then with jobs? I mean, how do you square that circle that we had 517,000 jobs created in January and another big number in February?
Well, I could tell you back, for example, 20 years ago, right before the economy went into recession, unemployment was close to its cyclical low.
Wow.
So you get these situations where every cycle is different. The labor market typically is lagging or coincident, meaning it moves with the economy. And you had a lot of companies, hard time finding workers. It's what we call labor hoarding.
Yeah.
And you also had a backlog of activities because you've been, supply shortage of product and goods, and projects have taken longer. But typically, Maria, when it turns very quickly.
Yeah. Christine Lagarde kept to the script, right? 50 basis points. People were surprised that the ECB raised.
Well, but also they were much slower in Europe to start raising rates. We started raising rates sooner than they did and far more aggressively. So actually, I would argue that Europe is just playing catch up, trying to get to where we are. We're right now at 4.75 on Fed funds, whereas they, were 3.50, and it took them a long time to get there.
That's exactly right.
Yeah.
Well, let's say that the Fed does raise rates today, even though you're not expecting that. You've mentioned the borrowing rates among families and the tightening financial crisis. If the Fed goes forward with raising rates, how much more do you think that the American consumer is going to be able to take?
Well, the consumer's already under a lot of duress. I would argue 25 won't matter, but the problem is that to the extent that deposits have left commercial banks, and last year the FDIC data show we've never had as big a fall in deposits as we saw. If T-bill rates go back above 5%, again, it's just only going to exacerbate the problems that we see of capital flight out of the banking system.
But let me push back on that, Joe. What could possibly drive T-bill rates back up to 5%, given that they backed off so much, given that the Fed is saying we're almost done or might be done, and given, well, I'll just leave it at that.
Okay, so if the reason T-bill rates have come down is the market thinks, well, the Fed will go today, they'll be cutting 100 plus by the end of the year. So the Fed doesn't validate those expectations, those market rates will go back higher.
Snap back the other way. 30-year is also coming in, right? 30-year fix dropping this morning to 6.48% for the week ending March 17th, and the national median existing home sale price also down, first time in 11 years on that, to 0.2%. Joe, what's the story on these interest rate sensitive areas, like housing, like autos?
Well, this is the thing, Maria. They show the weakness before the rest of the economy. They'll show the weakness before the job market deteriorates. The question I keep asking myself and I ask clients is, you look at the yield curve, the 2-year note has been well above the 10-year yield. And the reason the Fed has to cut rates is that needs to normalize where your longer rates are higher than your shorter rates. When long rates are lower than short rates, or put another way, if your cost of funding is more expensive than what you could lend at, banks don't lend, banks don't attract deposits. And the only way you've ever gotten that curve to normalize is with the Fed cutting. Otherwise, this crisis will persist.
Which argues for the Fed either doing nothing today or cutting. I don't think they're going to cut.
No, they're not going to cut.
Doing nothing, just sit tight.
Then their tightening ends when we're still at negative real rates?
But
doesn't inflation then resume its upward march?
No, because the thing with negative real rates is that inflation is the lagging of all the lagging indicators. If you look at market expectations of inflation, your break-even rate, your five-year swaps rate, those rates are actually back at 2%. So if you're borrowing, you're not worried about where inflation prints last month or what it's done over the past year. You're caring about what effectively is my real borrowing rate expectationally. And those rates are positive. And if it was all about real rates, real mortgage rates were negative for much of last year. Housing's still in recession because people aren't borrowing in the real world. They're borrowing in the nominal world. So those nominal rates have gone up.
Those are really important market signals. I believe in efficient markets. I think markets are efficient long term, but obviously the market, Wall Street, Washington consensus was transitory. Inflation, not a big problem. They were wrong. Now the consensus is, once again, it's fading away.
But it is fading away. I mean, PPI was in the mid-teens, 15, 16% producer prices. They're now, what, 4.6 as of last month? Consumer prices were, you probably know better than I, being the economist,
still high.
Like 11, and now they're sort of 5-ish.
Not as high as they were, but still high.
They're coming down.
I want to give you, to your point, I want to make two comments. One is, if you look at the oil markets, we're pricing lower oil. Now, that could obviously change, but the oil markets are pricing lower energy. And this is very important. 14% of the CPI is food. Fertilizer prices have collapsed. And if you look at the chart, it's got almost a 1-for-1 correlation with food, with fertilizer leading. So you're going to have a sizable portion of the CPI in the next 6 months that, in my opinion, will look a lot lower than where we are now.
What's priced into the market? I mean, if the Fed does nothing today, I mean, there are expectations. Like Larry McDonald came on the show the other day, said there's going to be a cut before July 4th. But what does that say to the markets? Because you could actually unnerve people to say, this is a lot worse than I thought.
But it's funny you say that. One of my good friends I talk to all the time is a big fan of yours. He's like, well, the Fed has to hike for a credibility issue. And I'm like, hold on. If things are really bad and hiking is going to make things worse, why are you trying to fool people by hiking to convince them things aren't as bad as they appear?
Good question, yeah.
And Yellen is basically admitting that. Look, if you're backstopping all these banks or committing to do more, things aren't great. So the question is, fundamentally, do we need higher interest rates? I'm going to say no. And again, I come back to the yield curve. Or to James' comment about inflation. Well, if inflation was such a big problem, why did the 10-year note never get above 4.25 if it was such a big problem?
Well, because the market is effectively telling you that long-term inflation is coming down, which is the good news. The 2-year shot way up.
That's right.
But long-term, inflation expectations are anchored.
That's right.
Yeah, it's taking longer than I thought, but the inflation is coming down.
So markets do what on a cut? Rally?
I agree with Larry. Larry and I talk a lot in full disclosure, but the Larry McDonald. I see a recession coming. And that means two things. It means, number one, we've not seen the low in equity prices. And secondly, we've seen the high in 10-year yields. Yields will go lower. And it's only when yields get to very, very expensive levels that you see the massive asset allocation back into stocks and the new sustainable bull market begins.
All right, we'll leave it there. Joe, it's great to get your insights as always. Joe LaVorgna joining us.